We are very excited you decided to join us today. We're happy to be here to support Susan G. Komen. We're also excited to have somebody that your colleague Mike Taylor just called, I believe, tall, handsome, and brilliant.
You said handsome.
Yeah, well,
You said
he's
handsome
right
twice.
about the tall part. No, I actually had the pleasure of listening to Mike talk. I think he's, everybody forgets how incredible he is from just an insight standpoint. Really privileged to consider one of my good friends.
Yeah, he is really smart. I mean, the ability to blend macro with what he's doing on healthcare. It's very, very cool what you guys are doing with Pink. Raising money for Susan G.
He was
Komen
really,
like
really smart, but it is actually important that people understand that he was the single last person admitted to Gettysburg State University in his class. So brilliance was not what he was known for early on in life. He was a snowboarder, and he ultimately changed the trajectory pretty amazingly. So one of my favorite interactions on a regular basis.
Well, it's good to get you on here and get a little bit of the inside info on Mike here after the fact.
Well, I represent the non-snowboarder demographic. So
yeah,
anyway,
I'm a
let's
skier
go.
myself. But anyway, yeah, we only got 30 minutes, so we probably should get going. Just a reminder to everybody, we're here for Susan G. Komen. And if you're watching on YouTube, there's links to donate. If you're watching on Twitter or on LinkedIn, you can come to YouTube to either one of our channels, SpotGamma or Excess Returns, and give. And if you can give, we'd greatly appreciate it. So Mike, I think we want to start off in macro with you. We're in a pretty interesting space right now. We've seen at least the measured inflation numbers have come up a little bit. The higher for longer camp seems to be winning in the markets a little bit more now. More people seem to be, as Andy Constant calls it, the island. More people seem to be moving over to the higher for longer island. Can you just give us your take on where you think we are right now?
Yeah, I mean, look, I've been very straightforward and candid about this. I think one of the unique dynamics that's going on right now is people very much want things to be bad, right? They want things to have high inflation. They want the Fed to be trapped. At the same time, they're using that really as a narrative to describe why markets are higher, right? The Fed is ultimately weak. The Fed is going to be forced to cut. The Fed is going to do X, Y, and Z. And meanwhile, this idea that inflation is persistent and continuing certainly can be true, but it is absolutely a projection. If we look at the underlying components of inflation, the areas in which we're seeing inflation today are the follow-on components to it, right? And so I'll just give a really simple example of that I've walked people through before. But if you think about what happens to auto insurance, for example, when the price of a car goes up, the cost to replace that car under an insurance framework goes up as well. Ironically, you're not paying any more for insurance. You're insuring a more valuable asset, and you should see your insurance costs go up to reflect that. And unfortunately, that is what we're seeing at this point. We're now seeing the pass-through effects of higher auto prices, higher auto part prices that are already in the price level into things like insurance. That's a regulated industry. And so the insurance regulators are looking at it from two standpoints. One, we have to defend the profitability of the insurance companies because we want to make sure that they are viable in terms of meeting the coverage that they have sold. And so they will allow a price increase of this type of magnitude in response to the increase in the costs that are realized that showed up as very poor fundamental performance for insurance companies roughly 2 years ago. But the difference is high insurance prices don't cause auto prices to go higher, right? So we're at that second stage in this. In fact, what high insurance prices do is they cause auto prices to fall for the very simple reason that people turn around and say, hey, I'm not going to buy a car. And it perversely shows up unless you hedonically adjust these things. Who are the people who can't afford to insure their cars? People who are poor and at the lower end of the spectrum and are already struggling with this. So this shows up as effectively a regressive tax that then reduces their access to cars in a way that actually creates all sorts of other ripples through the system, but largely involves a slowing down, right? That is different than a cost increase for cars. And it also ironically shows up in things like the demand versus supply components, because those are not properly tuned to capture this dynamic, right? If you think about the way those are supposed to work, they say, did price increase, and did that price increase cause demand, or did quantity consumed rise or fall? That's how those types of things work, right? Well, if I buy a car and my insurance cost goes up, am I buying more or less? I actually am not changing anything really, right? And so there's a slight increase in the quantity in force. that shows up as, oh my gosh, this is a demand driven increase in prices, right? Unfortunately, like it just doesn't work that way. And so there's limitations to all this sort of stuff that happens at every turning point in every cycle. Some people want to project forward on a linear path towards inflation. Some people want to project their political outputs. And that's really what we're ultimately seeing in the inflation data, where it has become effectively a political argument. Biden causes the inflation, or Trump caused the inflation, or, XYZ, right? And we see this. If you look at the Michigan report in terms of the outlook for the next 5 to 10 years, the really notable component is not the change in the median expectation, which has actually been fairly constant. What's really remarkable is the growth of the tails. And so something like 20% of respondents all of a sudden are saying, we expect inflation over the next 5 to 10 years to be 10% plus, right? Why do you think that? Well, because it's inevitable, money printing, right? Like these are not fact-based statements. We've introduced an extraordinary degree of emotionality into it that just doesn't really match the underlying data that we're seeing.
So I mentioned before the rise in the reported, inflation metrics recently. I mean, do you think what we're seeing in those reported metrics is overstating the true level of inflation we're seeing right now?
I don't think there's any question about it. And I find it ironic that people who 2 years ago or 3 years ago would criticize owner's equivalent rent and say it doesn't report true inflation are now suddenly defending it and saying, oh, look, owner's equivalent rent. And that's not coming down anytime soon, right? Even as metrics that are incorporated within the owner's equivalent rent look at what's happening on the margin where all prices are ultimately set. And things like the Cleveland New Tenant Rent Index are falling very rapidly.
Do you think there's a better way to do inflation? I mean, we have things like Trueflation right now that are trying to do it in real time. Do you think there's a better way to measure inflation than the way we're doing it?
Well, I think unfortunately, inflation is one of these things that's a little bit like pornography, right? Everybody has their own taste and experience in it. It was a joke. Obviously, when you see it, right? Nobody actually knows what my inflation experience is or what your inflation experience is. We all have independent ones that are tied to where we live in the country, what we desire and what we like. And if you happen to be somebody who is basically tied into the marginal behavior around that, right? So let's talk about a population expansion like millennials. Well, if you're buying the same thing as an expanding population, you're going to, by definition, experience a rising inflation component to it, right? On the flip side of that, if I look at a lot of the things that people really do buy in their lives on a continuous basis, things like automobiles, things like durable goods, things like televisions, things like speakers and entertainment centers, things like milk, eggs, etc., all of those have largely retreated. I mean, the simple fact is wheat prices are at the same level that they were 50 years ago. Right? Just stop and think about that. When we start talking about the deflationary forces in the 19th century, we're largely talking about a basket that involved things like wheat. We're talking about scraps of cloth, right? Jack, how much did you spend on your last scrap of cloth?
Yeah, it's been a while. I guess you could call some of my shirts a scrap of cloth, but
that's exactly right. We
and I didn't spend that much on
away
this
now because we have so much, right? So our consumption baskets have changed. They've become far more complex. They've become far more effectively protected by intellectual property. That's the only thing that keeps an iPhone cost up, right? It's the fact that I can't slap that label onto a Huawei phone and call it an iPhone and be able to sell it in effectively the same thing. They're all functionally identical except for walled gardens that are created by intellectual property restrictions. And the dynamics of the inflation component, the price of wheat has no material impact on American consumption patterns anymore.
So when you look at the Fed right now, do you think they're too tight? I mean, there's different camps in that. One looks at like the rate relative to what might be the neutral rate and say the Fed's really tight. Other people look at like financial conditions type indexes that include the stock market and things like that and say the Fed's not that tight at all. Like, how do you think conditions are right now?
Well, so I think conditions are, again, split by who you are, right? So if you are somebody who has borrowed and currently has debt outstanding, we typically call those young people. You are struggling, right? If you are somebody who has accumulated savings over your life in anticipation of spending down those savings in your retirement, you're suddenly sitting golden because the assets that you had accumulated are now offering you an income stream that is far above what you would have expected just a few years ago. And so this is exactly what we ultimately see. We see boomers benefiting, the older generation benefiting, the wealthy benefiting from this dynamic. And those who are at the lower end of the socioeconomic strata, they've actually seen, or at the younger end in particular, they've seen their prospects deteriorate materially.
So when you think about what the Fed should be doing here, I mean, they're meeting tomorrow. What is your view? I mean, do you think they should be cutting rates right now?
I think they should be cutting rates, but again, it's something that is totally up for debate depending on what your objective outcome is, right? If you think, as the Fed does, that higher interest rates are contractionary and that they should ultimately be driving inflation lower, then it becomes a question of how do you interpret the inflationary data that we've received? And what we're seeing are things like insurance costs going much higher, the cost of banking services, what's called the imputed cost, going much higher. At the same time, we're not seeing the same material benefit from the retreat in things like oil prices or energy prices that we saw last year. And so that's showing up a bit more in the headline and even in the core data, where again, that is effectively being pulled forward, right? We show insurance costs as core. We show banking services as core, even though nobody is actually writing a larger check to JP Morgan for their banking services. They're actually just receiving less relative to what they could get in a money market fund. And that's interpreted as a big increase in the cost of banking services. The fact that we now have to pay higher rates for securities lending because of an increase in the prime rate and the consolidation in the brokerage industry, that's interpreted as inflation, right? As far as I can tell, that's caused by the Fed and by our failure to enforce antitrust dynamics.
How much control do you think the Fed has here over inflation? You know, you could argue long rates are much more important for the economy. Do you think they have? You could also argue in like a fiscal dominated world, they're less powerful than they once were. How much control do you think they have over the rate of inflation?
So I don't think they ever really had that much control over the rate of inflation. If they actually did, we wouldn't have seen the structural dynamics of inflation behavior that's been largely tied to demographic features for the past 70 years. Right? Like it feels insane to say this to people, but when you actually think about how powerful the Fed is, what the Fed does control is the front end of the curve. And if the Fed decides to keep the front end of the curve elevated, let's just say randomly, Jerome Powell is reinstituted for a 20-year term and says, at no point in my term will the front end curve fall below 10% interest rates. Right? Well, what has to happen to the 10-year bond?
Yeah, it's going to go up.
It has to go higher in yield. Does that mean it's the right yield? No.
Not necessarily.
Right. It's what Jerome Powell thinks. And so it's really what's actually happening right now is the uncertainty that's being created in the front end is actually transmitting itself to the back end. It's not that the economy is getting markedly stronger or that we're seeing an improvement. The first quarter GDP growth, which by the way, the now casting components on a nominal basis missed by over 250 basis points. That's an extraordinary miss when you really think about it. It's not so much that the headline being at 1.5% versus expectations of 2.5% was the big miss. It's that the nominal number was such a huge miss, right? That's actually a really important development in my view.
How do you think the election affects economic policy? I mean, people will argue the Fed is trying to juice the market in the election or government officials are trying to juice the market in the election. How much do you think that affects policy?
Well, I don't think there's any question that the, political leaders, which would include the Secretary of the Treasury, right? So remember, there is no independence for the Treasury. That is an appointed position that serves at the pleasure of the president, subject to confirmation, obviously, by the Senate. If you think about that entity being political, there's nothing new there, right? And so do I think that it has an impact? Of course it does. Do they have degrees of freedom that allow them to do anything that they want? Of course not, right? They don't have the power. They don't have the capability to meaningfully cut taxes or to meaningfully raise taxes. They can propose it and it can be passed under Congress, right? But Congress ultimately controls that path. There is a legitimate concern that fiscal policy has increasingly moved to the executive branch because of the fears of the inability of Congress to act. Things like getting rid of student loan payments through executive orders or mandating that regulatory agencies don't report things like delinquencies on student loan payments. Those can absolutely be accomplished politically, but it's really fascinating to actually look at what's driving the increased level of deficit. At this point, it is all about the interest rate policy. All of the increase in deficit is being driven by the Fed itself at this stage. So ironically, all the concerns that people have around very high deficit levels would be largely solved if the Fed started cutting rates. And that in turn would then cause a secondary feature. If the Fed starts to cut the front end of the curve, then you can actually finance the back end of the curve. Right now, it's very hard because of the inversion in the yield curve to take a levered position in something like 10s or 30s. You can do that as the front end, and particularly in 2s, by the way, but you can do that as the front end of the curve falls in price, falls in yield, to be more accurate.
Just one more before I hand it over to Brent. I wanted to ask you about, you mentioned the deficit, and that's something many people are worried about right now, both the deficit and the large national debt. And some people will say that is a huge, huge issue for our country going forward. How big of an issue do you think the national debt is?
So I don't think that the national, all right, first of all, let's separate them into two components. The national debt can most easily be thought of as failed economic policy that didn't contribute enough growth versus the initial expectations, right? If you actually had made investments that drove significant growth in the United States, then we wouldn't actually be looking at the debt levels that we have. So really what the debt is telling you is this prior policy was not particularly good. That should not be a surprise to anyone who has actually observed policy over the last 20 years, right? Going forward, now the question becomes, do we spend that money well or do we spend it badly? And unfortunately, there's a ton of evidence that we're not spending it particularly well, right? That's what occurs when, you effectively, as Lacey Hunt says, increasingly have to devote the resources to paying off the mistakes that were made in the past. Had we spent that debt to build more roads, had we spent that debt to rebuild our nuclear industry so that we had unlimited supplies of low-cost baseload power, had we decided to spend that money on productive capability and effectively created a competitor to China that we're now being forced to suddenly reevaluate, right? Or to make investments in education that actually cause children to be better prepared for the workforce today, we wouldn't be struggling with these issues. But we didn't do that. And so now we have to deal with the ramifications of it. So is the debt a problem? Yes. But what it's telling you is that policy is the problem, not the actual debt itself. The debt is really equity when it's happening at the sovereign level, right? Saying, what are the claims on the resources of our economy? And we got a ton of claims that are tied to prior mistakes.
Do you think that policy can be adjusted to address that, or is that unlikely to happen?
So Adam Smith has a very famous line. There's a lot of ruin in a country, right? Particularly a country like the United States, which has extraordinary physical resources, which really does not have to spend that much of its national defense on defending itself because it has oceans on either side of it, relatively secure borders with relatively favorable neighbors, right? We don't have to spend that much protecting what we have. We're spending an awful lot of money basically trying to protect everything around the world and create conditions under which the world order doesn't change all that much. I'm not sure we're spending that money particularly well, is the argument that I would make. And it just comes back to the same thing. I don't think people are thinking in these terms, right? They're thinking in the terms of, this is impossible. We can't demand more. The system is ultimately totally corrupted. We need to get by with less, right? We've just lost the growth mindset. We'll eventually recover it. I think I'm highly confident that we will eventually recover it. But how long that takes, I can't tell you.
I know that you know Chris Cole, and I was listening to an interesting podcast interview with Grant Williams from November of 2020, and it was really interesting to listen back to that because it was he really forecast a lot of the things that I think were playing out today. And if I frame this correctly, he thought that we basically come to this situation where we're going to have to choose sort of a left tail or a right tail. And that had to do with, monetization of debt or sort of, taking the pain for, some of our past mistakes, so to speak. You seem to think from your conversation, from what I'm pulling from what you're saying, is that we can kind of hit the ball down the fairway. It doesn't necessarily have to be this left or right tail, outcome of everything that's happened really post-COVID. Are you familiar with that sort of idea? And am I reading you correctly there?
Yeah, no, I think we're saying the same thing, right? Which is the debt is effectively a measure of how much of the resources you have to put towards prior bad policy, right? And one way of getting rid of that debt is to effectively hyperinflate it away, right? Or to take advantage of the dynamics that we print our own currency and effectively cancel out the debt. The irony is the way that would take place is through, you can't actually just inflate the debt away, right? The great irony is if I look at the decrease that we've seen in the debt to GDP number, it's been a function of growth, right? Not just a function of inflating, right? We haven't done that much damage in terms of inflating at this point. And candidly, I would highlight for people, like, remember, we expanded our money supply 35%. We shut the entire world down. We started a war in Europe. We started a war in the Middle East. We are currently engaged in conflict with China. We shut down the Suez Canal. We had to reroute everything around the Cape of Good Hope. The water levels in the Panama Canal are limiting transit through that mechanism, et cetera, right? Basically, everything's going crazy wrong. And we're arguing about 2.5% versus 3.5% inflation numbers, right? Now, have we had a cumulative inflation of 25%? Almost certainly. Has the price level shifted to reflect those prior mistakes and the fact that we did not contract demand adequately in the face of lower supply? 100%. Like, people should really be thinking about all the things that we screwed up and how little impact it actually had. Like, that gives you some idea of that degree of how much room there exists in a country. And again, like, I'm in this weird position where I am hypercritical of the choices that we're making from a policy standpoint, but also highlighted for people that, like, to immediately project the end of the system, that the world is coming to an end, that inflation is going to run rampant, that they are in charge and are acting against our interests. Like, this is just political paranoia.
That's a very pragmatic view they have there.
Well, it's pragmatic to the extent that it actually ends up being right. And so, I'll just say very quickly that it's been wrong. I mean, the simple fact is that the U.S.'s financial house is in much better order than China's, much better order than Europe's. Right? We actually know these things. And yet, weirdly, we talk about the collapse of the dollar.
Well, I would also say, to your point, we talked about this several times with some of the other earlier guests, that volatility has really been pretty contained, even through 2022, I guess you could argue, even though we threw so many problems right at it, politically and fiscally and everything else.
Well, yeah, I mean, you've heard my explanation for 2022. I think that 2022 was much more tied to systematic portfolio rebalancing. And candidly, I think the lack of demand for interest rates is tied to the same thing. So if you build portfolios that say I'm going to be 50-50 equities bonds, right? And nowhere in that statement do you include, but I'm going to actually look at the level of yields, right? Or I'm going to consider valuation in equities before I make that statement of 50-50, right? Then you would actually expect exactly what we saw in 2022, which is the Federal Reserve hikes interest rates. Mechanically, that lowers the price of bonds. If I'm running a 50-50 bond equity portfolio and bond prices fall, what do I have to do? I have to sell equities, buy bonds, right? And so that's what we saw in 2022. Did we see a recession? Did we see a significant retreat in profitability? Did we see corporations stop buying back their own shares? In some cases we did, but for the most part, it was largely a story about a match in behavior between bond prices and equity prices that's consistent with this dynamic of systematic portfolio allocations. If I look at what's happened since, the Fed has paused interest rate hikes, right? We've increased the supply of bonds and we've decreased the supply of equities because we ended the SPAC nonsense and we've started shrinking share counts again. Well, if I'm running a 50-50 allocation in which my demand is largely fixed and the supply changes in the way I describe, I expect to see equity prices go higher and bond prices to go lower. And unfortunately, I think that's really what we've seen. I just don't think there's information content in the way that people think there is in the behavior of financial markets at this point.
And then is that due to a lot of the financialization of markets, essentially?
I think it's due to a combination of financialization and also the rigid application of rules that, if you stop and think about them, don't make any sense, right? The idea that I'm going to allocate my portfolio on a fixed basis after we've seen the type of change in interest rates that we've seen is extraordinary, right? But if I look at a Vanguard website and I look at the expected return to bonds in their portfolio construction techniques, it's totally unchanged from where it was in 2021.
Right. Fascinating.
Right. So why would I change my portfolio construction if my expected returns remain the same? Even though we know that that's prima facie absurd. We've gone from negative 3% real rates to positive 2.5% to 3% real rates And everybody's saying, well, bonds are certificates of confiscation still. Well, they have to be at least slightly less certificates of confiscation, right?
Right.
But nobody's thinking about them that way.
Well, Mike, thank you for doing this. I guess you have proven Mike Taylor's compliments correct.
I am tall, you're right.
Yeah. Well, you're not standing, so we don't know that, but the brilliant part you have. So thank you again. We really appreciate you taking the time.
Nice talking
Thank
to
you.
you.